Welcome to our 2021 webinar series. LLIS believes that in 2021, knowledge is key. Each month, you'll learn key insurance solutions to better your insurance knowledge. Our insurance specialists keep up with the constant changes in the insurance industry, especially during a pandemic. Our specialists will review some basics, use case studies to show how LLIS crafted risk management strategies, and answer your insurance related questions. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. Today's webinar will be recorded and will be posted on our website within a day in case you missed it. Today's presenter started working at LLIS in 1998. Since then, she's become LLIS's go-to person for connecting your clients with long-term care insurance solutions that meet their needs. Here's Jill McNeil.
Thank you, Claudia. Good afternoon, everybody. Thank you for joining us today. November is Long Term Care Awareness Month, so it's only appropriate that we talk about long term care today. And what are we going to talk about? We're going to talk about comparing long-term care options. If your clients have decided they do not want to self-insure and want to look at some type of policy, then that's what we're going to look at today. And then next, we're going to move into talking about the Washington CARES Act. This is a new tax that was passed in the state of Washington. And you may wonder, well, why is that appropriate for me if I don't live in Washington? Well, stay tuned. We'll talk about that. And then finally, we're going to talk about current long term care policies that are having rate increases and the letters that your clients are receiving from the companies about these rate increases and options they have. So let's get started. First, let's start by looking at cost of care around the country. Now, these numbers are the median cost of care for the country, about 106,000 for a private room in a nursing home, just over 93,000 for a semi-private room in a nursing home, 51,600 for assisted living, almost 55,000 for a home health aide, and 53,768 annually for homemaker services. You may be wondering what's the difference between a home health aide and homemaker services? Well, home health aide is somebody that provides more hands-on care, comes into the home and assists with eating, bathing, dressing, whereas homemaker services is more hands-off. They come to the home and maybe help with food prep, house cleaning, and grocery shopping. And you'll see I also have the numbers here about the percentage of increase of these costs from the year before. You see assisted living has the biggest increase, and that's surprising. Usually assisted living is pretty steady or very low increase. It may be because of the pandemic. More people that would maybe have gone into a nursing home are more tempted to go into assisted living. And you also see that home care is increased a fair amount. Again, I think more people want to stay in their home as long as they can and be a little bit safer in their home. And I've also read that home health care has become more expensive because of low unemployment. People that have more can go to more desirable jobs. They can make more money doing something else. They're not forced to do the home health aide, the lower paying job. But again, these are median costs for care around the country. If your client lives in New England or maybe California, Hawaii, Alaska, the costs are going to be much higher. So when your clients are looking at possible cost of care in the future, make sure they look up cost of care in their area because that's very important for their planning. So now that we've looked at cost of care, how can they pay for this care? So there's two options. The first option is option one, use personal income and savings. So this is what we mean when we say self-fund. They're using their own assets to pay for their care. So and when you talk to your clients, if they decided this is the route they wanted to go, ask them some questions to see if this is what they really want to do. Will they be depleting their retirement income, therefore affecting their lifestyle? If they have a long term care event, especially early in retirement years, that may affect the assets they have for the rest of their retirement and all their plans. Do they plan on relying on family members to provide their care? Do they have family members that are nearby and willing and able to provide their care? And do they want their family members to provide that care? Will they need to liquidate portfolio assets, possibly selling at a poor time or creating unplanned taxes? So, if your clients have assets that are not liquid, such as real estate, will they have to sell that off at an unplanned time and therefore not taking best advantage of that? Do they have a surviving spouse who will need a certain level of assets? So again, if you have a couple and one of the spouses needs care and they drain all the assets to take care of that spouse, then the healthy spouse, what's going to be left for them? So ask these questions to your clients to help them really think about this. So the other option to pay for care is to transfer the risk to the insurance company by purchasing a policy. They could purchase what I call a traditional long-term care policy, or they could purchase a linked benefit product, such as a hybrid life with a long-term care rider or a hybrid annuity with a long-term care rider. If your clients want to purchase a policy, ask these questions to help them determine what may be the best product for them. So here are some things to think about. Is the long-term care the primary driver for the coverage? Or do they have other needs? Example, do they need a death benefit for estate planning? Do they have supplement retirement income, etc.? So ask them what is the goal of this product and how do they want to pay for these premiums? Do they have to pay lifetime premiums? By lifetime premiums, I mean paying a lower premium over the years for the rest of their lifetime. Or could they afford to do a short pay premium, like a 5-year premium or a 10-year premium, or even a lump sum? Pay the one premium up front, be done with it. Or do they have some existing life insurance or some annuities with some cash value that they could exchange, do a 1035 exchange into a policy to help fund? And do they want guaranteed premiums? If they want guaranteed premiums, then the hybrid life policies are really the way. Hybrid life, hybrid annuity is the way to go. The traditional long-term care do not have guaranteed premiums. The premiums can be increased by the insurance company. Are they reluctant to pay premiums if they never need care? So again, with traditional long-term care, if they pay the premiums, they never need care, then they've paid their money for something that they've never needed. If they want a guarantee to have something for that premium, the hybrid policies provide the death benefit, the long-term care, return of premium, or annuity value. So again, these are questions to ask to help determine what may be the best product for them. So let's compare these long-term care options. And here's a case study for Cindy and Mike. We're going to say they're both age 58, and they live in Tampa. They need long term care. They know they want some type of coverage, but they want to know their options. They have no existing life insurance or annuities with any cash value, so they're going to have to write a check. And they have moderate assets, so they want a policy to help supplement a portion of their long term care expenses. So we would start by looking at cost of care in Tampa, because again, that's where they live, that's where they plan to retire. So the median cost for home health care in Tampa, $4,576. Assisted living, 3,225. 9,946 for a semi-private room in a nursing home, and 11,391 for a private room in a nursing home in the Tampa area. So if they were looking for a substantial policy, we would recommend they cover 80% of that most expensive cost, that $11,391 of the nursing home. But as I said, they have a fair amount of assets. So what they're looking for is sort of a worst case scenario so that if they do end up in a nursing home, they have a policy to help them defray those costs. So we'd recommend they look at a moderate policy that would cover 50% of the nursing home cost, 50% of that private room of nursing home cost. So that would be a monthly benefit of $6,000. So with a $6,000 monthly benefit, that's large enough to cover 100% of the home health cost and the assisted living and 50% of the private room in a nursing home. So again, worst case scenario, if they did end up in a nursing home, they would have to supplement out of their own savings for about 50% of that expense. So what are the options for Mike and Cindy for coverage? Again, traditional long-term care policy or hybrid life. Let's start here and compare the two. And just a review about a long term care policy, or what I call a traditional long term care policy. With these long term care policy, you have a choice of benefit periods from 2 to 6 years, depending on the company. Benefit periods, or I'm sorry, benefit amounts, $50 up to $300, or monthly benefit would be $1,500 up to $10,000. Elimination period 30, 90, I'm sorry, 30, 60, 90, 180 through 65. Again, depending on the company and depending on the state. Inflation riders, we don't have as many choices on inflation riders as we used to. Nowadays, it's pretty much 3, 4, and 5% compound inflation. Don't know any long-term care policies that still offer simple inflation, and we don't have any companies that offer that future increase option that we used to be able to get in the past. And with the long-term care policies, the premiums are lifetime premiums. In the majority of cases, lifetime premiums, and the premiums are not guaranteed. So the insurance company can raise the premiums if they go to the state and ask for a rate increase for all policyholders with that policy series. Can never be on an individual basis. And they have to show justification to the state for this premium increase. So let's look at a long term care policy for Cindy and Mike. Again, we're looking at that $6,000 monthly benefit. Going to recommend a 90-day elimination period. This is the sweet spot on elimination periods. You can save a little bit by going with a longer elimination period, but the money you save on that longer elimination period is not really justified when you think that, like, for example, if Cindy and Mike went to a 180-day elimination period, they're going to have to pay out of pocket an extra 90 days. That's 90 days they're going to lose out on that $6,000 monthly benefit. So $18,000 more out of pocket they're going to have to spend with that 180-day elimination period, and the premium they saved on the 180-day is not going to justify that. We'd recommend a 3-year benefit period each with a shared care rider. Well, why 3 years? Average length of stay, or, I'm sorry, average length of care a male needs is 2.2 years. For a female, 3.7 years. So having 3 years each, we add the shared care rider on so they can share their coverage. It's like having 6 years to share between them. So it's going to cover the most likelihood of events. No, it's not going to cover every situation. There are people that do have more than the average length of stay, but only about 20% of cases last more than 5 years of needing care. So again, 3 years would cover the most likelihood of events. And we'd recommend the 3% compound inflation rider. So this means that every year their benefit will increase by 3%. Every policy anniversary, their benefit will increase by 3%. The 3% does not keep up 100% with inflation, but it keeps up pretty well. We could do a 4 or 5% inflation rider, but the extra premium for that level rider is not justified. Really haven't sold a 5% compound inflation rider for many years. It's mostly 3%. So Mutual of Omaha and NGL, National Guardian Life, are the two long-term care companies we are currently working with. So with both companies, we get them the benefit they want. Mutual uses a monthly benefit, so we're using the 6,000. NGL uses a daily benefit of $200 a day. Multiply that by 30 days of the month, it's equal to a $6,000 monthly benefit. With both of them, we can get that 3 years with a shared care. We get the 3% compound inflation rider. There's no return of premium on these. Some of the companies still offer return of premium riders. We generally don't recommend it. Uh, they're good. There's so many restrictions on these return of premium riders on the traditional long-term care policies. We don't recommend it. No death benefit. Again, these are just straight long-term care policies. Form of long-term care payment. Both of them are reimbursement policies. Pretty much nowadays, all traditional long-term care policies are reimbursement. Well, what's reimbursement? So when they go on claim, they have to satisfy the 90-day elimination period, and then the care, they have to pay out of pocket for their care. And then at the end of the month, they submit invoices to the insurance company, and the insurance company will reimburse them up to their monthly or daily benefit. Care for reimbursement has to be provided by a skilled or certified caregiver. With reimbursement policies, you cannot use a family member or friend to provide the care. The premium for both of these, 11,261 with Mutual of Omaha, NGL 7,030. Usually there's not that big a difference within the two premiums. Many times NGL with a couple is a little bit less, but Mutual of Omaha has pretty high rates in the state of Florida. So in this case, we'd recommend that NGL policy for them. Okay, now let's look at a hybrid life policy for them. So what is a hybrid life policy? It's a permanent life insurance policy with a long-term care rider. It guarantees they're going to receive some form of benefit from this policy, either in the form of a long-term care benefit and or the death benefit. As they receive when they're on claim, as they receive long-term care benefits, the death benefit is reduced dollar for dollar. Upon the death, any remaining death benefit is paid to the beneficiaries. Many of the policies have a residual or a guaranteed death benefit, so they do get some form of death benefit. The hybrid life policies have guaranteed premiums. The insurance company cannot go to the state and ask for a rate increase. And many of these hybrid policies have some form of return of premium, some better than others, and I'll show you that in a little bit, a couple slides. The hybrid life have flexible premium options. You could do a single pay or a short pay, 5, 10, 15 year, and some of them even offer lifetime premiums where you can spread that premium out over the lifetime. The hybrids don't look as good when you do the lifetime premium. They're more attractive when you do a single pay or a short pay. And the hybrids, you can fund them with a 1035 exchange. When we do a 1035 exchange, the rules require that the existing policy and the new policy have like insured and like owner. So when we do a 1035 exchange, and it has to be uh, so we, if the husband owns a life insurance policy and we 1035 in it to a hybrid life, it has to be on him only. We cannot add the wife. We cannot add a joint insured for these hybrid life policies. For this demonstration or for this webinar, we're going to focus on linked benefit policies where the long-term care is a priority. There's many products out there now that are very basic hybrid, where they're a permanent life insurance policy with a rider that allows you to access the death benefit early. So those are very basic. We're not going to talk about those today. We're going to really concentrate on the ones where the long-term care benefits are larger than the death benefit. With these linked benefit policies, the death benefit is small and the long-term care benefits are large, and where you can add on inflation riders to these linked benefit policies. And think about these hybrid policies having three pools of funds or three piggy banks. The largest piggy bank is the death benefit, or I'm sorry, is the long-term care benefit. So if they need care, they have tax efficient dedicated funding source designed to meet their needs. So again, on these linked benefit policies, the biggest pool of benefits is the long-term care benefit. The second largest pool, or the median piggy, is the death benefit. This death benefit can provide a legacy. If they don't need care, they're able to give their family member a legacy through the death benefit. And then the smallest piggy, the little piggy, this is the return of premium, meaning they can get their money back. If they change their mind, they're able to get some of their money back. One of the company offers, Securian offers 100% return of premium. Most of them offer some form of return of premium. So again, three pools of money or three little piggy banks in this policy, in these policies. So here we're going to talk about a hybrid life policy for Mike. The majority of these hybrid policies are individual policies. So in this case, we're going to talk about an individual policy for Mike, and we're going to look at a 10-year premium or a 10 pay, because as I said earlier, this is with the short pay premiums where they look most attractive, and many people um, can afford a 10 pay premium versus like a lump sum premium. So these three companies, Minnesota Life, Lincoln, and Nationwide, all three of these have a good product and their premiums are very competitive. With all three, we can get that $6,000 monthly benefit we're looking at. And we're going to go with a 4-year benefit period on these. They do have a 3-year benefit period, but the way the base policy works and the long term care riders or the continuation of benefit riders work, the 4 years actually look more attractive than a 3 year. Sometimes the premiums are even lower for 4 years. And when you look at the total long term care pool for the 4 years, again, they look much more attractive than the 3 years. Death benefit, you can see in Minnesota Life and Nationwide, they always have the same death benefit, 144,000. I mean, the same as each other. It's not always 144,000. In this example, with that $6,000 monthly benefit, 4 years death benefit 144. Lincoln has a little bit higher death benefit of 156,000. Again, remember these are individual policies. We can get that 3% compound inflation rider on all of them. Return of premium. Minnesota Life has 100% return of premium after paying premiums for 10 years. The Lincoln Money Guard is 70% after paying premiums for 10 years. Nationwide does have return of premium. It varies by age, sex, and year, so you really have to look at the illustration to see what the return of premium is. So in all years, there's some return of premium, but it just gets better as you go along. Form of long-term care payment. Minnesota Life and Nationwide are indemnity policies or cash policies. So what this means is when Mike goes on claim, satisfies elimination period, qualifies to receive care, qualifies to receive benefits, at the beginning of each month, the insurance company will send him a check for his monthly benefit. And he can use that however he wants. He does not have to submit any invoices to show how he used it. So with indemnity policies, you can use unskilled caregivers, such as family members or friends, to provide the care. So indemnity is a very nice policy compared to reimbursement. Lincoln is a reimbursement policy, just like that NGL and Mutual of Omaha policies that we looked at earlier. With reimbursement, you have to submit the invoices every month. You have to show how that you received care by a certified or licensed caregiver. Elimination period. Minnesota Life nationwide, the only option is an automatic 90-day. Lincoln is nice because it does have a 0-day elimination period. You can start to receive care right away. Residual death benefit or guaranteed death benefit. So this means even if you use up all the long-term care benefits, you're going to be guaranteed to have some form of death benefit. Minnesota Life 10,000, Lincoln 7,800. Nationwide has the largest guaranteed death benefit, $28,800. So what are the premiums on these? So Minnesota Life 13,285, Lincoln 15,591, Nationwide 14,228. So Minnesota has the lowest premium, very attractive. It has Minnesota Life is also attractive because it has the highest return of premium. It's an indemnity policy. Now Lincoln has the highest death benefit. It has a 0-day elimination. So if your clients are more interested in the higher death benefit or they like that 0-day elimination, they may want to pay a little bit more for the Lincoln policy. Nationwide has the highest residual death benefit, and it is an indemnity policy. But what we find most of the time, people are looking at the lowest cost policy as long as it is a good product, and this Minnesota Life is a very good product. So in this case, I'd recommend the Minnesota Life policy for Mike. But we also have to think about Cindy. So if we were to purchase the same policy for Cindy, the same benefits and everything, their combined premiums for Cindy and Mike, Minnesota Life 27,904, Lincoln 33,120, and then nationwide 29,779. So Minnesota Life is a little bit higher, but I would still recommend the Minnesota Life because of the benefits it has, the higher return of premium, indemnity. It's a good product. Okay. So I did mention that there is one company that offers a joint hybrid policy, and that's State Life. So it's a second to die whole life policy with a long-term care rider. It pays a death benefit upon the second death. Remember, it is a second to die policy. It provides long term care benefits that they can both use. They can both be on claim at the same time. If they're both using benefits at the same time, they can access each can access the full monthly benefit. So they'd be using 2 months of benefits. It does offer a lifetime benefit option. So most of the other hybrid policies, or none of the other hybrid policies that I know of, offer the lifetime benefits, but State Life does. And State Life offers many premium options, including lifetime premiums. They offer the single pay, I think 5 pay, 10 pay, and lifetime premiums. So if your clients really want a joint policy, they may want to look at the State Life policy. Now let's look at the State Life policy compared to the individual policies with Minnesota Life, Lincoln Nationwide. It's very similar. The main difference with the State Life, again, is that unlimited benefit period. So if you have clients that have a family history of Alzheimer's or a cognitive issue, they may really like this uh, unlimited benefit period with State Life. Uh, State Life again has that one death benefit of 200,000. So when you look at the other companies, it does have a lower death benefit and it has no residual death benefit. And the premium on State Life 39,120. Considering that it's unlimited benefit period, it's really not that much higher than when you look at these other policies. So again, a good option for your clients that want a joint policy and they want to have something with unlimited benefits. Okay, so that's hybrid life. Now let's compare the hybrid life to, well, let's compare all three. We're going to compare the traditional long-term care with NGL, with that Minnesota Life, the individual hybrid life, to the One America or State Life joint policy. So let's assume that they purchased a policy and at age 83 they went on claim. So let's compare how all three of these compare if they went on claim at age 83. So after paying premiums for 25 years for the two of them with NGL, they would have spent 196,840. That's assuming they had no rate increase. With the Minnesota Life, those were 10-year premiums. After they each paid premiums for 10 years, they would have spent $279,030. Those are guaranteed premiums, so that's a guaranteed number. With State Life, paying the 10-year premium, $391,200, and again, that is a guaranteed premium, so that's guaranteed. Total long-term care pool with NGL, 890,366. Remember that was 3 years each with a 3% compound inflation, so it's still a nice benefit pool. With the hybrid life, they each had 4 years of benefits with a 3% compound. So between the two of them, they'd have 1,224,642. So a very nice pool. And then State Life Unlimited, they both can go on claim. They could go on claim tomorrow and be on claim for the rest of their life. So unlimited benefit pool. No death benefit with NGL, 288,000 for Minnesota Life because of the two death benefits, and then the State Life with 200,000. No return of premium with NGL. Minnesota Life has the highest return of premium at 279,000. State Life still does have has 142,444. And looking at long-term care payment form, NGL and State Life are reimbursement, and Minnesota Life is indemnity. So that looking at this, Minnesota Life, the individual hybrid policy, has median cost, costs a little bit more than the NGL, but for that extra premium, you're getting a very large long-term care pool, not as high as the State Life, but a good pool. You get the highest death benefit or the largest death benefits with Minnesota Life, and you have a full 100% return of premium, and it's an indemnity policy. So I would say the Minnesota Life is the most attractive policy here. You get everything for your money. You get, as I said, you're guaranteed you're going to get something, either long-term care, a good long-term care pool, death benefit, return of premium, and it's an indemnity policy. So if your clients can pay the a higher premium up front, then the hybrid life policies may be the way to go. But the NGL, the traditional long-term care, is still a good option for many clients. Those clients that can't afford the large upfront premiums, purchasing a traditional long-term care policy is still a good option. If their main goal is just to have a long-term care benefit or pool, that long-term care with NGL is still a very good option. Now let's talk about, here's another case study with Carl and Molly. And we're going to say Carl's 60, Molly age 55, and they need long-term care. Carl has a life insurance policy with $123,000 of cash value, and he no longer needs that death benefit of $275,000 on that policy. Kids are growing up, out of the house, mortgage paid off. So he doesn't need that. So they know they need long-term care. So they're wondering what can they do with that 123,000 to cover both of them for long-term care. Well, the answer is a hybrid annuity with a long-term care rider. So what is a hybrid annuity? It is fixed deferred annuity with a long-term care rider. It provides a monthly long-term care benefit for both of them. Long-term care pool is 66 months, so that's a total pool. They'd have to share it. Very minimal underwriting on this hybrid annuity. There is some medical underwriting, but it's very limited. So we've had clients that did not qualify medically for traditional long-term care or hybrid life that could qualify for the hybrid annuity. The kind of difficult part on this annuity is that the only form of premium payment is a single premium, and it has to be non-qualified money. So very little underwriting, but single premium is the only option. Nice thing is you can use 1035 exchange. You can 1035 exchange funds and add on a spouse. So in this case, where Carl has the life insurance policy, he's the owner insured. The laws will allow us, or the rules will allow us to roll this into this joint hybrid annuity, add on his wife as the second annuitant, and she can use the long-term care benefits. Remember, I said earlier we cannot do this with a hybrid life policy. Hybrid, the rules won't allow us to exchange into a hybrid life and add on a spouse, but we can do this for the hybrid annuity. So that's very nice. So if Carl and Molly took that money and rolled it into the hybrid annuity, what would benefits would they receive? They would have a 2,563 monthly long-term care benefit that they each have access to. 66-month benefit period. If they both went on claim today and used a full monthly benefit, they could each be on claim for 33 months. They'd be using 2 months of benefits. 90-day elimination period, that's the only option. 5% compound inflation rider on the COB rider. No option to add an inflation rider on the first, I think it's 30 months of benefits. But on the last 36 months, the continuation of benefits rider, we can add that 5% compound inflation so it would grow. So we're able to take money that Carl had sitting in that existing life insurance, roll it into a hybrid annuity, and use it for the two of them. So a good option in cases. Again, a good option when your clients are not in good health. Now, let's talk about another type of policy, short term care. This is a product that came on the market a couple years ago. If your clients maybe can't afford the premiums for the traditional long term care or the hybrid life, maybe the short term care is a good option for them. I would call this Plan B. These short term care policies offer facility benefits, meaning nursing home, assisted living, hospital indemnity, which would help. Hospital indemnity means it would pay an extra benefit along to use in the hospital along with their regular health insurance. And we can add a rider onto the policy to provide home care benefits. Benefit periods 90 days up to 360 days. So it's called short-term care. So that's why the longest benefit period is 360 days. Elimination periods 0 days up to 100 days. Issue age is 50 up to 89. With traditional long-term care, the maximum issue age 79. And the hybrids, I think, are 79 also. Limited underwriting on this short-term care plan. So it's kind of like the hybrid annuity. There is some underwriting, but it's very limited. Now let's look at a short-term care policy to give you an idea of premiums for Kate. And Kate lives in Atlanta, age 55. Looked at cost of care in Atlanta. We'd recommend a $200 daily benefit amount using that 80% rule, covering 80% of nursing home costs. Went with a 100-day elimination period, kind of like the 90-day elimination with short-term care. Went with the longest benefit period, 360-day benefit. Went with the lowest hospital indemnity benefit. This hospital indemnity is not a rider; it's part of the policy too. We have to do it. So I just went with the lowest, $10. Added on the home health care rider, so she can receive care at home. Maximum benefit, $1,200 a week for 52 weeks. Premium for Kate, $726 annual. So a decent benefit gives her 1 year of benefits for $726. So if we were to compare this to a traditional long-term care policy for Kate, let's see how the short-term care stacks up. So I tried to run benefits as close as I could. So with both $200 for nursing home and assisted living, $1,200 weekly benefit for home care for 52 weeks with short-term care. Again, the maximum with the traditional long-term care, it's $200 a day for 2 years. Okay, 52-week benefit period for home care. But you can use it twice in your lifetime. So Kate could use that $1,200 for 52 weeks twice in a lifetime, not for the same claim. But if she went on claim and then off again, I think she has to be off claim for 6 months and then became sick again, she could use the policy a second time. 100-day elimination versus a 90-day elimination with long-term care. There is no option to add an inflation rider onto these short-term care policies. With long-term care, we can add it on, but to make these policies kind of apples to apples, I did not add the inflation rider onto the long-term care policy because I wanted to compare premiums. The short-term care 726, the long-term care $1,636. So when you look at it, the long-term care, we know you can use 2 years of benefits. The short-term care can only use 2 years if it's two different claims. So the premium for the short-term care is less than half of the long-term care premium. So again, it's a good option for those clients that need, maybe they're older or not in good health and can't afford that single premium with a hybrid annuity. Okay, let's change gears here a little bit. I'm looking to see if I have any questions. Oh, okay, I have a question here. It says, at what age or situation do you recommend having LLIS run long-term care scenarios for clients? I would recommend when your clients are in their mid 50s. At this point in their lives, they're starting to think about retirement. They've spent the prior years building up their assets. Now they're concentrating, wanting to know how long those assets will last them when they go into retirement. So they've shifted their focus a little bit. Premiums at this age are reasonable. Once you get past age 60, long-term care premiums go up about 4 to 6% every year that you do not purchase the policy or you wait to purchase. Before that, it's about 2% per year, 1 to 2% per year. Also, once you get into your 60s, your health can change so quickly. Unfortunately, none of it, we never get any younger, and usually our health never gets any better. So I'd recommend you start looking at options in mid 50s, 56, 57 for your clients. Okay, I have another question here. Says, what is the prior rate increase the traditional premiums? The example does not consider premium increases. Is there an industry average to use over the next 25 years or so? So what they're asking is, historically, what have long-term care premiums gone up? Unfortunately, there's no average. I have seen rate increases from 8% to 98%. Depends on the policy, depends on the product, depends on the state. So 40 years ago when these products came out, they were not priced correctly. The actuaries did not know how to price them because they did not have any claims history or lapse history. They were not priced correctly. Over time, as they've gained this knowledge, they've done a better job pricing the products. They've taken away a lot of riders. They've modified the policies. They went from unisex pricing to gender specific. They did away with short pay. So they're doing a better job pricing the long-term care policies nowadays. And so I don't think in the future we'll see as many rate increases or as higher rate increases. I think we'll still have rate increases, but not as high. I have a lot of advisors say that they tell their clients to plan on a 4 or 5% rate increase every year. They're not going to have that every year. A lot of the insurance companies long time wait many years to do a rate increase, and then they may hit you with a high rate increase. So if your clients plan on a 4 or 5% increase every year, eventually when they do get hit with that rate increase, they should be ready for it. Okay, now let's get back to the presentation. So here we're switching gears, and we're going to talk about a new tax or a new law that the state of Washington passed recently, and the Washington CARES Act. And this uh, law will take effect January 1st, 2022. And what this is the state is requiring that the Washington CARES Act will is requiring that many residents pay a 0.58% payroll tax on most people, and I'll get into that a little bit more. And the state of Washington, they're gonna the 0.58% salary tax is to the residents are going to fund their own long-term care policy. And this long-term care policy is a very minor policy. It's a $100 daily benefit for 1 year benefit period. That's the state policy. The policy is not portable. So if you move out of the state of Washington, you cannot take it with you. You have to pay into the policy for 10 years before you can go on claim, or 3 out of the last 6 years. So it's not a good policy that this tax is funding. So the state gave residents the option to purchase a qualifying private long term care policy. And if they purchase this qualifying policy, they can opt out of paying that 0.58% tax. And if they wanted to purchase that qualifying policy, they had to purchase the policy by November 1st of this year. So policy had to be in force by November 1st, 2021. We started hearing about this probably in March, and our phones started to blow up about from Washington clients wanting to purchase a long-term care policy to opt out of this tax. Why did the state of Washington do this? Well, they're encouraging their residents to purchase their own long-term care policy so they would not be as dependent on Medicaid. Medicaid is the largest single payer of long-term care sales and services in the United States. In 2016, total Medicaid long-term care LTSS spending, combined federal and state, was 1.54.4 billion, which comprised 42.2% of all long-term care sales and service expenditures. So by doing this tax, the state of Washington will be reducing the burden on the state's Medicaid system. The Long-Term and Support Trust Act will save taxpayers $3.7 billion by the year 2052. So how much and who? Again, the tax is 0.5% payroll tax on all employee wages. There's no cap on this. So it doesn't matter if your salary is 100,000 or $1 million. Everybody has to pay that 0.58% payroll tax. Except it is on all W-2 employees. It's on all wages, including stock-based compensation, bonuses, paid time off, severance pay. They're subject to tax. So pretty much any employee except self-employed individuals, employees of federally recognized tribe, certain collective bargaining employees, and any employees that opted to purchase that qualifying private long-term care policy, they can opt out of that tax. We don't think that this will only be a Washington state issue. In July of this summer, New York Representative Thomas Sushi introduced the Well-Being Insurance for Seniors to Be at Home, or the WISH Act. He wants to create a public-private partnership that would create a trust fund to pay for catastrophic care for those who need it. It would be funded by Social Security contributions made by workers and employers, with contributions equal to 0.3% of wages. When we were preparing this webinar, I looked to see if that tax had passed. I could not, or that act had passed. I could not see that it had passed yet, or what the latest was on it. Uh, and other states are looking to do the same thing that Washington has done. These states looking into it. As last I looked, there's a total of 12 states considering doing the same type of act or tax that Washington did. I'm hoping that other states learned from what Washington did. Washington did not do a good job letting their residents know all the particulars of the tax, especially what type of policy they would need to purchase to opt out. So hopefully other states will learn. And if your state does decide to implement the same type of tax, be ready to get your clients moving. If your state starts a long-term care program, you may not have as long as you think to get a policy, private policy in force. So how did each company address this? So Mutual of Omaha on June 7th, they said they started receiving a large amount of applications from Washington. They said we're going to require a minimum of $3,000 monthly benefit and a minimum they have to have a 3% inflation rider on the policy. They started getting applications for tiny little policies, 30-year-olds applying for long-term care, which you never see. So they decided we want to make this worthwhile. We want to have policies that are halfway decent and some decent so in the future, when these clients go to pay use these policies, they have a better product too. And on June 17th, of Omaha shut it down. They said we're not going to accept any more applications from the state of Washington. They gave us 1 day notice. There was no more time. They said they needed time to underwrite all the applications they had in house from Washington before that November 11th deadline. NGL on May 27th, they said we're going to require minimum $100 a day on the application, have to have a 3% inflation rider, and in order to apply, you must have had a physical with lab work in the last 24 months. On July 2nd, they said, okay, now we're going to say you have to, all applications have to have a minimal annual premium of at least $2,000. Doesn't matter if it's an individual or joint policy, it has to be 2,000. On August 5th, they said, okay, we're going to increase this to 3,000 for any applications received after the 6th of August. And then on Monday, the 9th, they said, okay, effective today, we're shutting it down totally. We're suspending sales in Washington. Um, Many of the other hybrid companies did the same thing. This is what the NGL said. In the last 3 days from Washington alone, we have received the equivalent of 3 months worth of submissions from the entire U.S. So again, the insurance companies were overwhelmed with applications from the state of Washington. So a lot of people that wanted to get policies to opt out, they couldn't. So with most companies not accepting applications 3 months before the opt-out date, talk to your clients as soon as possible, as soon as you know your states have going to implement this tax. Explain this is a long-term care policy they should keep forever. So what I mean by that is if they apply for a private policy to opt out of the tax, and in many cases the premiums on a private policy would be less than that tax that we would have to pay and they should hold on to the policy forever, not just get the policy and drop it. Washington had said originally that we're only going to check in with you once to see if you have that private policy. But after they realized people were going to start canceling their policies once they opted out of the tax, Washington has decided that they are probably going to change the law and go back and check with people to make sure they're holding on to the policies. And who should you talk to first if your state implements the tax? Don't talk to the retirees because those retirees, if they don't have a long term care policy in place now, they need to plan on a better policy than just that minimal policy. And plus, they wouldn't have enough years to pay into that tax to be eligible to receive benefits. And your clients that are middle ages, the premium that they would have to pay on an individual policy would probably be more than the tax that they would have to pay. Plus, they probably need a better policy than just that very minimal benefits. So, who should you talk to? You should really talk to the young clients, the ones that are high wage earning, young, that if they purchased a minimal long term care policy, they'd have a better product, better private policy, and they would pay less in premiums than they would in tax. For example, Mark and Tina, age 36 and 35, and we had to say they were in the state of Washington when we ran this because we couldn't even run quotes in the state of Washington. We said they're in Oregon. We couldn't even run it for Washington because software shut down. So this is the very minimum policy that we would recommend they look at, and it would qualify to opt out of the tax. So the combined premium on a private long-term care policy for the two of them, $1,787. So if their combined income is more than 308,000, the tax that they would have to pay would be higher than the premium for this long-term care policy. And as their income goes up, the tax they have to pay is going to go up. So for Mark and Tina, they'd be better off to purchase their own individual long-term care policy and opt out of that tax. Okay, I see we're running out of time here, but for this last section, I'll go through fairly quickly. Here we're going to talk about rate increases on existing long-term care policies. Maybe your clients have received letters from the insurance companies informing them that they're going to have a rate increase, but giving them some options to reduce their benefits, to lower the premiums, and still have a decent long-term care policy. So when your clients have a rate increase offer, review their current benefits, see how they stand up. What's their age? If the clients are in their 70s or 80s, you're going to look at a lot differently than if they're in their 50s and 60s. In their 70s and 80s, they're closer to going on claim. And what's their financial situation? Has it improved since they purchased this policy? If they purchased younger when they're in 50s, 60s, maybe they weren't sure how long their assets were going to last them. Maybe now that they're older, they have their assets, they're doing better, they've done better in the market, they have more assets than they thought they might. So maybe they can afford to go down on their benefits. And talk to them. Do they have family members nearby that would help them if they need care? How does their monthly or daily benefit compare to current cost of care where they live? Again, look at cost of care where they live. What percentage of care is covered of the three different types of care? They may want to reduce their daily or monthly benefit so they at least have 100% of home care and assisted living covered, but maybe 50% of nursing home care. Again, then if they have assets to be able to supplement 50% of nursing home care. Look at that elimination period. Usually it doesn't make sense to increase the elimination period. So many times I recommend they keep the elimination period where it is, especially if it's a 90-day elimination. Look at the benefit period. Is their benefit longer than they needed? I mentioned this before. Average female needs 3.7 years of care, male 2.2 years of care. Home health care, about 2 years is the average. It's hard to measure because most home care is provided by family members or friends, not recorded. Assisted living average 28 months, nursing home 485 days. So if your clients have an existing policy, maybe with unlimited benefits, that's nice, but many people don't need that. Or maybe they have a 5 or 6 year benefit period and they could afford to scale that down. Here, this is again showing how cost of care has increased over time. So if they have an inflation rider on the policy, they generally want to hold on to it because they need to be able to keep the policy increasing. If they have a 5% compound inflation, maybe they want to consider going down to 3% and still have a decent increase on their policy. So here's an actual true life case study. Sally and Jack, age 71 and 74, they purchased a policy from us, their main residence. They purchased a Genworth policy in 2012. They had 5% compound inflation, $100 daily benefit, 150 is now $233 a day because of that 5%. 3 year benefit period with shared care rider, 180-day elimination period. They had a rate increase. Their new premium is $2,546. And they came to us wanting to know how they could change their benefits, or should they hold on to their policy, or could they get a new policy with the same benefits for less premium because they thought, okay, we had this rate increase. Maybe we can do better. Well, I ran a quote for them, a new policy with the same benefits, $14,860. So recommend they hold on to this policy. So then we looked at, okay, how could they change their benefits and and reduce their premium? So we started by looking at cost of care in Maine, $172 for home care, $159 for assisted living, $345 for semi-private and nursing home, $375 for a private room. Their current daily benefit is $233. So I recommended they not adjust that daily benefit because they, if they take that down much lower, they're not going to have very much to spend on nursing home costs. So I recommend let's keep it at $233. So Genworth, in their rate increase letter, Genworth sent them these options. The column one here, right here, shows their current benefits. Over here, Alternative A, B, and C were options that Genworth sent them to consider to reduce their benefits and keep their premiums lower. Well, all three options uh, take down that daily benefit from the 230 to 70 cents. So I did not like it when I talked to the client, he agreed with me. He wanted to keep his current daily benefit at $232. So we called Genworth and we talked to them and asked them to send us some other options. So again here, this column here is their current benefits. Option A, B, C, D, and E are options that Genworth sent to the client to consider, again, to lower the premiums. So in option A, if we take the inflation down from 5% down to 3%, it'll save him $270 on his annual premium in year one. Okay, so that is a 10% saving. Option B changes the benefit period from 3 years to 2 years and changes the compound inflation from 5 down to 3. Total saving of $735 for the year annual. So that's a 28% rate decrease or premium saving. So that's pretty substantial. Option C, take the benefit period to 2 years, keep the inflation at 5%, saves them $501. So just by going from 3 years down to 2 years, saves them 18%. Option D, keeping the benefit period at 3 years, going from 5% compound to 5% simple, saves them $285 or 13%. And then option E, taking the inflation rider off the policy totally, saves them $612. So this would save them the most amount of money, 24% on his premium. But they're still in their early 70s. It could be another 10, 20 years before they go on claim. They don't feel comfortable taking the inflation rider off totally. So this client was thinking that he was going to go with option A and just take the inflation rider from 5% down to 3%. And then in the future, if he has more rate increases, he could consider going down on the benefit period. So for here, I just wanted to show you how changing different parts of the policy affects the premium to give you an idea. Okay, I have one more case study. Tony, age 70, and Karen, age 56. Again, this is a real case scenario. These two are Florida residents, and they did purchase this Mass Mutual policy from us in 2000. They had received a letter from Mass Mutual. This is their first rate increase. So they've had the policy 21 years. This is their first rate increase. 5% simple inflation. Their current daily benefit is $600 now. 90-day elimination period, unlimited benefit period, indemnity rider. So it's a reimbursement policy. They added on this rider so that it would be a cash benefit. Their quarterly premium now is $924. Uh, they wanted to know Mass Mutual sent them a rate increase. So what Mass Mutual is saying, okay, this year you're going to have a 25.98% rate increase. Quarterly premium will go to $1,165. In the next 2 years, you're going to have the same rate increase. So after 3 years, premium $1,849. In this case, the wife called me and told me that her husband was recently diagnosed with cancer, probably will not live out the year. She cannot afford to pay the premiums on this rate increase, but wants to keep a good policy. This is a joint policy purchased together. It's unlimited benefit period. So if we change the benefits on one, the other policy has benefit change. So we could not take his policy down to very low benefits because if we did that, then hers would have to. So benefits, the changes we had to make we really wanted to make with her in mind to give her good policies. I ran a quote to see what a new policy would cost her with the same benefits she has. The largest daily benefit I could do was $300, so half of what she has now. Premium on a policy today, $6,186. So about 6 times the premium with half the amount of benefit. So she realized how valuable her policy was. So again, we looked at cost of care in Tampa. $375 per room in a nursing home. She has $600 now, so she's got lots of benefits. This is the rate increase letter that Mutual of Omaha sent her. They did not give her many options. She could go from unlimited down to 6 years, 3 years. benefit amounts go down and change no options for daily to reduce that elimination period. I called Mass Mutual and said, "Can we go down to 400 a day?" And they said, "No, we can go down to 410." And her quarterly premium will be $776. So with 410, she still has more than enough benefit to cover cost of care in Tampa. I asked her what if we went down to 3 years, asked National Mutual if we went to 3 years and 410, 504. If she went to 6 years, $699 quarterly premium, much less than what she's currently paying, and still have a good policy. Her premium in 2021 with no changes, $1,165. So we saved her about over $450 by doing that change. If we took off the indemnity rider, it would save her $231 a year. All right. I'm sorry I rushed through that last part. It took a little longer than I thought, but let me see if we have any questions. Okay. Okay, I see some questions here. What is the maximum age for a short-term care policy? It's 89. So again, a very long, very late or very uh, benefit. I'm sorry, maximum age 85. So 89, a long time to purchase a short-term care policy. Asked how much approximately is your short-term care plan for an 89-year-old. I'm sorry, I don't know. I would have to run the quote to see. To be honest, I've never run one for 89. It would be pretty expensive, but a lot less. Well, can't even get a long-term care policy for an 89-year-old. But to be honest, most people at 89 would not consider buying a policy. Can undocumented immigrants get a long-term care can get long-term care coverage? Uh, I don't know if they can. They would have to have a driver's license and probably social security number. So, to be honest, I don't know if an undocumented immigrant could do that. I don't believe so. Does it make sense to change from a traditional policy to a hybrid, or should a hybrid be added on? Are there policies accepted by CC residences? So, first part of the question, does it make sense to change from a traditional long term care policy to a hybrid? Usually it does not. So as you saw in my examples here, if your clients purchased a long-term care policy um, several years ago, they should hold on to that policy because uh, rate increases, getting older every year, those old long-term care policies, you do not want to replace them because even if they've had rate increases, the premium on those older policies are still much less than a new policy today. What I would recommend is if they need more coverage, add a hybrid policy on. So keep the long-term care policy and add a second policy being a hybrid life policy. If they went on claim, the rule of thumb is they'd have to go on claim on the policy that was put in force first. And then if their traditional long-term care policy didn't cover all their expenses, then they'd have to file with the long-term with a hybrid company. And next part of the question asks, are policies accepted by continuing care residences? Yes, they are. Usually, I think it depends on the type of continuing care residence. Um, if you have a reimbursement policy or indemnity policy, actually, if you're in a continuing care community and then your health gets worse and you qualify with the triggers to go on claim with a long-term care policy with indemnity, they're going to send you a check, especially with the hybrid policies, the hybrids that are indemnity, they'll send you a check and you can have that money and put it in the bank. So you're paying your CCC dues or already paid it. You're going to be reimbursed with that indemnity policy. Okay, question. Will a parent with an Alzheimer's affect the underwriting for a child who is currently in her 50s? So with traditional long-term care, Mutual of Omaha, if you have one immediate family member, parent or sibling with Alzheimer's, they're going to limit your monthly benefit to 5,000. That's the max you can apply for. NGL does not. The hybrid companies do not if you only have one family member. If you have two immediate family members with a history of Alzheimer's, doesn't matter what age of diagnosis, it's going to make you uninsurable for traditional long term care with Mutual of Omaha and National Guardian Life. With the hybrids, I have not seen that it makes you uninsurable, but for traditional long-term care, it does. If the client does a 10 pay and they are paid up, are they done? Yes. So if they have a 10 pay with a hybrid policy, pay their premiums for 10 years, they have to no more premiums to pay. They have their policy for their lifetime. So yeah, 10 pay, you're paid up, you're all done. You can pay it, forget about it. You have it for your lifetime. Question: how significant a shift have you seen away from traditional long-term care to hybrid policies, if at all? So I see more people asking to see hybrid life quotes, and we are selling more hybrid life policies every year. I would still say the base majority of people still purchase a traditional long-term care policy. People want to see the options, but when they look at the premiums for the hybrid life, many times they can't afford that premium or they don't want to put the money up front. But I am selling more today or this year than I did last year, but still a lot of people are purchasing a traditional long-term care policy. How might these public long-term care programs like Washington program affect inflation on long-term care cost? Might it accelerate inflation or is it not correlated? I how about these to be honest, I don't know how these long-term care programs might affect inflation on long-term care costs. I don't know if you mean like long-term care costs, meaning assisted living or nursing. I don't think it'll affect that. Um, and I don't know the impact that it will have. I'm sorry, I don't have the answer on that. Um, might it accelerate inflation or is it not correlated? Not sure if you're meaning is it going to affect inflation on long-term care premiums. Um, I don't believe it'll affect the premiums. I think time will tell. It's hard to tell. Okay, I read that Washington never included annual attestation so people can drop these new policies and the state won't know to reinstate the payroll tax. Yes, that's what we had read originally, that the state was requiring the residents to check in one time to show that they had these individual long term care policies. But as time went on through the summer, Washington realized that the residents were planning on purchasing these private long term care policies and then were going to drop them. So I've heard that the state of Washington has gone back and is trying to pass legislation to change this so that they can check in with residents and make them show again that they have a policy. So we are recommending that clients that did purchase a policy hold on to it for at least 2 years, so we know have a little more time to see what the state of Washington is going to do. The state, this whole thing with Washington is sort of unknown. We have heard that the tax that they're charging is not going to be enough to fund it, and in time they'll probably have to increase that tax. With Genworth having a 31 Comdex rating, is there a chance at some point in the future they won't be able to pay claims? What happens then? Yes, we stopped selling Genworth policies about 6 or 7 years ago when their financial profile went down so low. They were almost bought by China Oceanwide. That fell through, and their Comdex ratings and financial ratings have really plummeted. In the future, if Genworth cannot pay the claims, and gets into financial trouble, the Guarantee Association in each state would step in. In order to do business in a state, the insurance company has to join the state's Guarantee Association. So all the insurance companies pay into this fund. It's kind of like the FDIC at the bank. So if Genworth gets into trouble, the Guarantee Association will step in and pay claims. In most states, the Guarantee Association will pay up to about $300,000. It varies by state, but it's 300,000 per individual, so up to 300,000. So that's kind of the worst case scenario. Okay, I think I've got through most questions. If you have any other questions, I know I've run over time. Please send me an email or give me a call, and I'd be happy to ask any other questions for you. Thank you all very much for attending. I appreciate it, and have a good evening. Goodbye.